Hey, hello, and welcome everybody to today's workshop. I want to first say Happy Mother's Day to all the mothers out there. Hope you're having a wonderful day. And you might be out at brunch right now, and you might be catching this later. So hopefully, when you get time, you can sit down and take a look at this workshop today. My name is Jason Hamilton. I'm the founder of Keep It Simple Financial Planning. And what I want to talk to you about today is really a question from somebody here on the page that I thought just a really good question, and I thought many people would actually benefit from this discussion. So, one, I want to make sure that everyone's doing well. So, if you could let me know in the comments, is everyone still doing well? Are you happy? Are you healthy? Are you guys ready to burst out of the front door? Or are you more of the type that you would rather just stay inside for a while with all the crazy news going on? In California, we're supposed to be opening up this weekend, and we were just driving out to go check out, in the ocean here, they're having something called bioluminescence, where there's something going on with the algae or the plankton, I guess you could say. They're feeding or mating or something like that. But when you step in the water and or disturb the water, it actually turns like bright blue. So it's a really cool thing to see this weekend. But the real important part was that we actually got out of the house for the first time and actually went out and did something and got to go to the beach for the first time in like a month and a half. So that was really really nice. And so I think the traffic, by the way, was just crazy. It seemed like it was like a holiday, getting down by the beach there. So I mean, just cars and cars and cars. Tons of people outside. So I think here in California, we are getting just very cooped up. We've been cooped up, and we're just ready to get out and just get back to whatever this normal is going to be. It seems like there's like kind of a split in the groups, right? There's some people that are wearing full masks and really nervous about all this, and then there's some people that just see this whole thing as a bit got overreaction, a bit of overreaction at this point, and they're out here just kind of getting back to life like they normally would. So I'd love to hear kind of where you're at on it. I mean, I think where I'm at is just trying to be safe and keeping your hands clean, keeping your hands washed. But I don't think I'll be wearing a mask outside, walking around in the streets like I've seen some people. They're literally walking on the sidewalk by themselves, nobody there, just wearing a mask. And so I don't know, if I'm that extreme, but I think it's good to be safe and it's good to take this seriously. But at the same time, I feel that a lot of people are just ready to get back. Yeah. And so first couple people, Tamara and Larry, doing okay, still ready for this to be over. So I think we're all really at that point right now. So I think there are some vulnerable populations that should be considered we should protect them, obviously. But I think for a lot of us, we're just ready to get back to life. So what I want to talk about today is, we've had one of the biggest bounce backs in the S&P 500 in the last week. There might be some of you that are getting, your thoughts more on, can I retire? Or should I retire? Or how should I be getting ready for that? And I think there's versus a few weeks ago when you might have seen your counts down 20 or 25 or maybe even 35%, depending on how aggressive you are in the markets. You might have had a different perspective, like you thought you might have to work longer, right? So there's a question that came up, in the group. I thought it's just something really interesting to talk about. And with what's going on right now and the uncertainty we're probably facing for a while here, I think it might be something to think about as you are getting prepared and getting yourself set up for the next steps here when it comes to making sure that you don't have a huge surprise, the month or the year before you want to retire. And I think it's just really important to be thinking about, a few years ahead at least, and getting your plan together and making sure that you're prepared and that you don't get hit with something like this, because hopefully there's not another virus or something like that, but there's probably going to be other things that come up in the future. And you might be thinking about, when's the right time to start, reducing some of the risk in your portfolio? Should you change the funds that you're in? Should you be, doing something different than something like a target date fund, which in all honesty, I've analyzed a few target date funds in the last few weeks here. And from company to company, they're very, very different. I've seen some that do a good job of overall diversification. And then I've seen some that are just not diversified at all, like 80 or 90% in large cap stock, no mid cap, no small cap. And so I really, when it comes to retirement, I think you should be thinking about your overall portfolio in a way that you can section up the money or break up the money. We call it time segmented investing, right? So you have money that you need early on that could be safer, money that you don't need for 15, 20 years could be more aggressive. but really thinking about having the funds broken up in a way, because if you just have everything in a target date fund, it's basically just going to drop off. It might be at 50 or 60% and then just go down to 30 within a couple of years of equities, I should say. And that may not be right for everybody, you know? And so having a portfolio that is designed for you, for your needs, for what your income requirements are going to be, how much you need to spend is going to be very individualized. What I want to give to you today is some questions to ask and some ways that I would think about it, and maybe some ways that you can think about it as it comes to going to this next step here in retirement. So yeah, so it looks like, yeah, so getting some different things here. So in Massachusetts, Rebecca said that masks are mandatory in public. Kind of weird to say that they're going to be mandatory when you're just out in the open, right? Here in California, it's been, from county to county, it's actually very crazy. You might have heard Tesla, Elon Musk, the owner of Tesla, is talking about moving his factory out of California because in his county, I think it's in Alameda County up in Northern California, Fremont area, they are not allowing him to open back up even though the rest of the state opens back up. And then the county right next door, they have another factory doing something else that's been open this whole time, running 24/7, and they've had no problems at all. And so, it's just a really kind of a messy situation. I'm just glad I'm not the one having to really make all these decisions. I don't think it's easy, but it's good to hear that everyone seems to be happy and healthy. Pat, great to hear that you're happy and healthy as well. Through phase one, wearing gloves, mask, keeping distance. Yeah, I mean, I just think it's smart to do, but it's kind of interesting again to see just people out in public on the streets with no one around them, just wearing a mask. I feel that would restrict some of your oxygen in your breathing, and maybe that's not quite healthy. But hey, what do I know? But what I want to talk about again today is some questions here around. When is the right time to change your retirement funds to less aggressive funds, right? So this is a question that literally was just a quote that somebody had asked. And so I really like to take questions if I can and answer them in your words. And something else I should actually mention is I do want to spend more time trying to help everyone out here. Normally I do, just workshops on Sundays. I really want to start doing more of these because I just think right now there's a lot of people that have a lot of questions and maybe you're not sure who you can ask or where to go to ask. So I want to start coming in here and answering more questions for you and just discussing with you kind of how to think about making this transition in a time that might not feel confident, right? The market doesn't feel as confident as it did just a couple of years, or even last year, but even a couple of years ago, you might have felt a lot more confident transitioning to retirement. And maybe right now you're not thinking that as much. So, what I have is just really knowledge on history, how I think about things. And so I want to do my best to kind of add some of that to you and to your knowledge base as you're getting ready for this next step. So let's talk about this a little bit. Let's see here. All right. Okay. And so, of course, I do have to mention here that we're talking about investments, right? But I want to make sure that you understand this is not investment advice. This is for educational purposes. Should not be seen as legal tax or really any sort of advice. What I want to do is give you a way to think about this and some questions to ask for yourself as you are creating your plan here for the next steps if you're getting close to retirement. So this can be such a wide question, right? Should you go to less aggressive funds before retirement? And in reality, when you look at like the whole space of the mutual fund space, there's somewhere around 4,000 plus mutual funds that are out there. And so in reality, most of these funds are actually, pretty similar. If you look at like a large cap, excuse me, if you look at a large cap stock fund, it's going to be probably 80 or 90 or maybe even 98% similar to most of the other large cap stock funds. Same thing with small cap, same thing with mid cap. So when you're talking about, should you change your funds to less aggressive funds, what in reality I think you should be thinking about is how do you actually allocate the funds that you have between things that are more of the growth and then more of safe type of funds, right? So if you have funds that are, if you're sitting, let's say you're 2-3 years away from retirement and you're at 80 or 90% of equity in your portfolio at this point, you really have to ask yourself, is the extra risk that you're going to be taking worth the extra returns you could possibly get? I think for folks that got hit, last month or last couple months with the downturn and they were too high in equities, they'll probably tell you that it's not worth, taking the extra risk if you're that close to retirement. I personally would tend to agree, and I would prefer that, when you're getting somewhere within 2 to 3 years of retirement, that you really focus more on having the money that you need to be there versus trying to get a little bit greedy and squeeze out a couple extra percentage points of returns, right? So that's kind of how I want you to think about it. So the first question is, how much will you need for the first 2 to 5 years? Generally, money that you need within somewhere between 2 to 5 years should be kept more conservative, right? You want to keep that's going to be safe, that it's going to be there for you so that you can have a predictable or a predictable bucket of assets that you can pull from and you can make sure are there. Right now, things are very, very unsure these next couple of years. I really think we're going to see probably a little bit of an increase and things may be getting better, after this particular quarter. I think the government's saying third quarter or whatnot. But I think just talking with some of my banker friends, and these are folks that manage, thousands of real estate units, they're very concerned about areas like commercial real estate over the next 12 to 18 months and maybe even sooner. There's a lot of companies, even big companies, that are saying that they're not going to be able to pay their rents, they're not going to be able to pay their lease. And so, at some point, there's going to be government assistance that runs out, and the piper is going to have to get paid, as they say, right? You're going to have to pay your dues. And so it's probably going to get dragged out a little bit here. And I think what the government's hoping right now is that we can just kind of weather this storm, while everything's been closed down, soften the blow to the overall economy, and then hopefully the majority of people can start to feel that recovery, coming in within the next 9 to 12 months. But on the other side of the coin is what's going to happen to the people that things don't go as well, right? They may have gotten a government loan or something, like one of the PPP loans or the EIDL loans that will cover them for the next 9 to 12 months. But what happens if they're in industries that just aren't going to be quite as good as they were prior to this particular crisis, right? I think there's some industries going to be harder hit than others. Industries like travel, travel is probably going to be hit for a while. I think things will open up. We'll be able to take flights again, but I think the confidence and the consumer confidence in spending and traveling is going to be a lot lower, right? A lot of folks I've talked to that were huge fans of going on cruises, right? That was one of the main things they did with their retirement vacations because, cruises can be great, are just really not feeling comfortable being on a cruise on a ship with thousands of people being trapped in such a small space, especially when you go to those, to the, what do they call them, the cafeterias where you can get all the food there, and everyone's touching the handles, right after each other, touching plates, glasses exposed. It's going to be really interesting to see how they handle this to try to protect people and keep their industry alive. But I think there's going to be some trouble in certain areas like that. So on the other side, there's going to be some industries that actually probably do a lot better, right? If you're looking at companies like Amazon, I think they're hiring somewhere in the neighborhood of 100,000 employees, right? So I think the market, when you look at when people say the market, generally what they're talking about is the S&P 500, right? Kind of the 500 biggest companies in the U.S. And there's going to be probably a big mix of what we see going on here. But if you are looking at retirement and you know what you need for, and I would say start with really working out your retirement budget, right? So start with working out your expense needs for the first couple of years, maybe even the first 5 years, and get really, really clear on that. And then try to do your best to use some sort of inflation number, something like 2 or 3% of inflation that your expenses are going to increase each year over time. And then once you figure out how much you are going to need for this first 2 to 5 years, then I think that portion of money, right, it doesn't mean you need to change your funds, right? So the question that was asked was, should I change my funds, right, for my retirement savings? And a lot of times you're not going to need to change your funds, but you might need to change your allocation, right? So if you are retiring somewhere in the near future, and I usually recommend somewhere between 2 to 3 years, before retirement to start thinking about reducing that risk. And you want to start with, okay, well, how much are you going to need that first 2 to 5 years? And this will depend on your risk tolerance, right? Higher risk tolerance, 2 years probably of safe money is going to be good for a lot of people. But those that are more conservative, you might want to have more like 5 years. Because it's just, one thing is, it's really going to help you sleep at night if you have 2 to 5 years of money that's just kind of off to the side and that is safe. But when you're getting within 2 or 3 years of retirement, it's just not really worth the extra risk. So start with how much you're going to need, possibly for 2 to 5 years. Figure out your risk tolerance, figure out what your expenses are expected to be, and figure out how much you're going to have to put aside so that you have what you need there without having to maybe change your plans, like I heard a lot of people talking about a couple months ago when the market dipped, about having to extend their work career for a year or two longer than they expected. But once you know that amount, that's going to give you the starting place to figure out, okay, when I look at my new allocation, I'm going to have to keep at least X number of dollars in a very safe place. And then that starts to tell you, okay, if I'm 90% in stock funds, for example, and you're going to need to spend maybe 20 or 25%, the first 5 years of retirement. Well, now you know right there, you probably have to reduce some of your stock funds down to where you can keep 20 to 25% of your income need aside in somewhere safe. Okay, so that's kind of where I would start that, and then just kind of go use that as a baseline, as a starting place for your allocation. Okay. Then next question is your risk tolerance. What is your risk tolerance? How are you feeling these last couple months when the markets have been more turbulent? How are you feeling right now when the news is on and you have, some people like the Treasury, Steve Mnuchin is saying they believe by third quarter we're going to see things pick back up and we're going to have a great 2021. Are you more on the optimistic side like that? Or are you more on the pessimistic side where you're looking around and you're seeing, Airbnb owners losing all their properties? You're seeing, business owners maybe not be able to open back up. You're seeing commercial real estate properties getting, basically their lease is not getting paid on them. And you're more on the pessimistic side where you think this might drag a little longer. Really, this is an individual question, right? And this is the hard part where, it's not really going to be the same for everybody. But what you have to do at the end of the day is make sure that you're going to be able to sleep at night personally. And so understanding your risk tolerance is a very individual thing. But, really digging into that. And there's some online questionnaires, right? And those are a good place to start. But I really think there is an art and a science to getting risk tolerance right. And the number is a good place to start if you take one of those online surveys. But you really have to go as well and do a gut check to see, how did you feel when the market was down 30%? Were you like, hey, you know what? The U.S. is all, the market's always come back. Things will be fine. Or did you have that gut check where you just didn't even want to look at it? You didn't want to open your accounts. You didn't want to face that, and you didn't want to think about doing anything at that point except freeze and hopefully not sell. Or I guess you could say even the whole opposite side of the equation, where did you sell, right? Did you sell out of the markets at one of the dips that we had at the bottom, and now are sitting, with 10, 15, or maybe even 25% less money than you had a few months ago? This is such an important question, and this is something that a lot of individual investors don't get right, and they end up making bad decisions. So, when it comes to working with someone like, hey, say like me, who's a professional, it's like, what we help people do sometimes is stay calm, be a sounding board, because we're looking at this stuff every day, where if you're going to work, 8, 10 hours a day, you're probably not looking at your accounts every day. You're probably not looking at the markets every day. And so, your risk tolerance may be, not what you expect it to be when you see things going on that are a little bit more extreme than you're used to. So again, ask yourself this question: what's your risk tolerance? How did you feel when the market took a dip a few weeks back? And did you sell? Did you ride it out? Are you going to be, comfortable if something like this continues and we have more turbulence over the next year or two? Because we don't know if there could be another outbreak. We don't know if there could be another shutdown, temporary economy shutdowns. So it's really something that is going to come to you on an individual level. Okay. All right. And then, the third thing I want to just ask you about is, what rate of return do you need to meet your long-term expenses, right? So this is something that a lot of people don't really think about. Most people may put their information into some sort of online calculator or, some sort of, Monte Carlo simulator, right? And you get a percentage and it says, you have an 85 or whatnot, right? And so what that generally means is in 85% of the situations that were ran, you would have not ran out of money by the whatever age you put in there. 15% of the time, you would have ran out of money, right? So, of course, you're probably going to put in something like 90, for example. I mean, I don't know what most people use, but then you also have to consider, what if you live longer, right? So something we do with clients is we run a stress test and say, okay, well, what if you lived another 5 or 10 years longer? How does that play out? And then the other part to that is, when I ask a question like, what rate of return do you need to meet your long-term expenses? What you have to remember is you're not going to get the same rate of return every single year, right? In 2019, you might have had 25 or 30% returns. In 2020, you might be down 5 or 10 or 15% or more at this point. And so it's not going to be a very consistent linear rate of return that you're going to get. But on average, the markets are reasonably predictable over long periods of time. When you look at periods of 10 years or 15 years, you can reasonably predict what a certain asset class is going to deliver back to you when it comes to an expected return. So once you understand what the rate of return that you need is, and then you can start looking at long periods of time, what the type of assets you're invested in have done, then you can start to really get a relatively clear picture on if you what sort of rate of return that you might need. So something to be thinking about now is, if you need a relatively high rate of return to meet your goals, that can get a little bit scary, because if you're expecting somewhere around 8, 9, or 10% consistently every year, and that's what you need to meet your goals, you might get a little bit of a surprise as we have some volatility over these next couple of years. And there is something that is very real that is called a sequence of returns risk, right? You might have heard this before, a sequence of returns risk. So what that means is, if you are drawing on your portfolio, right, early in retirement, and you have a market downturn at the same time, and you continue drawing the same amount, that can really cause havoc on the back end of your retirement planning, because you are drawing more than you probably should. So this is why I like the idea of you keeping, a short-term bucket of money that, that money's not going to earn really anything right now. It's just the honest fact that interest rates are so low, you're not going to earn a whole lot. You might get lucky to get 1.5% or somewhere in that range in an online savings account, or maybe 1% in some sort of money market. But you're not going to get rich off of this money. But at the same time, if you have that money set aside, you're also not going to lose, right? You're not going to have to face a 30 or 40% downturn that may sit there for a while. And 2008 and 2009, it was about 17 months, or so until a balanced portfolio came back. And that's a long time looking at your portfolios being down. In this period right here, we saw things dip down to some of the small cap funds I saw had gone down maybe 35%. They're still looking down. But within this last week, things are getting back. And most people have a reasonably diversified portfolio. And so they probably are feeling a little bit better this week because things have come back a little bit and maybe aren't feeling as stressed. But what if your portfolio was still sitting down 30, 35% right now, and it sat down, 20, 30% for the next year, year and a half? How would you feel, right? Would you feel the same way you're feeling now by keeping your equities as high as they are? If not, then that might be something you want to think about. But, understanding how much you're going to need for your expenses, for sure, within the first 2 to 5 years, because that's the money that should be safe. Really getting clear on that picture, and then looking at what rate of return do you need to meet your long-term expenses. I think those questions, the answers to these questions, are what's going to help you determine the proper mix for your portfolio. And if you do need to make some changes, then probably within 2 or 3 years of retirement is when you want to be looking at that. 5 years is probably a good idea too. Within 5 years is a reasonable time frame to be thinking about that, but for sure within 2 or 3. So if you're with less than 2 or 3 years away from retirement, you definitely want to be looking at your overall portfolio. One other point I'll mention on this. Let me get here. One other point I'll mention on this is it's probably better, right? And this is a tough one, right? This is a tough one. It's probably better for you to be more conservative in the early years of retirement, because maybe, by the time you get into, let's say 70 or, 67, when you hit full retirement age, by the time you have your Social Security kicked in, maybe all your pensions are kicking in at that point. And then also by that point, you may not need as much spending, because generally most people are more active in the early years of retirement. You can start to kind of, ratchet up the risk. So that's called an increasing glide path, right? So if you start your retirement more conservative, right? So less volatility, possibly less returns, possibly not always the case, but possibly. But then as you get into retirement and your spending needs start to go down because you're not taking as many vacations, you've kind of bought your car that's going to last you a while, you've done the home repairs and things like that. It can be pretty big expenses early on. Once you get that stuff squared away, and later into your 70s, you can start increasing your glide path. So when you look at your overall retirement time frame, you can still average a reasonable return. But if you have, the market that goes down early and you're drawing, that goes back to that sequence of returns risk. You're adding, a lot of risk to running out of money on the back end. And the problem with that is it's not going to show up until it's probably too late for you to go back to work and get a job to make up the difference if you cannot draw from your portfolio, right? So let me check for some questions here and see if anything here is coming in that I can answer for you guys. So I think I'm getting some questions here from well, we'll see. Let's see here. Okay, so let's talk about this here. There's a couple good questions here. All right, so this one I like. All right. So Scott asked, hope I'm doing well and staying safe. Thank you, Scott. I'm doing very well, staying safe, healthy. Everything's good here. Where would you recommend saving a bridge account, as we'll be retiring in 2 years at 55 and not touching retirement accounts until 59 and a half? Okay. So we got about a 4.5 year period here. So this kind of falls within that 2 to 5 years, right? So Scott, what you probably want to start with is what's your risk tolerance, right? If that money was down, more than 20%, how would that affect your retirement? If it was down 30 or 40%, how would that affect your retirement, right? So if you just want to keep it 100% safe, interest rates right now are just not high. So an online savings account is probably going to be, the safest bet right now at 1.5%. There are things like, you could do short-term annuities of some sort possibly, and those are paying in the neighborhood of 2.25%. Those can be okay, but then the problem is, you could be locking up your money, right? Or there could be penalties if you want to get the money out before that time period. So depending on, do you have an emergency fund, right? Do you have another cash fund aside that you could draw from if you needed it? Or if you had a big emergency that you had to pull from, if you put this money into some sort of like short-term annuity, for example, they pay a little bit higher, but you could potentially have a penalty. Would you have to tap that if you did? If you would potentially have to tap that, then probably, the extra, 75 basis points or 1% that you might get from having in a product like that might not be worth it. It's a pretty, small difference over 5 years between 1.5% and 2.5%. It's just not really going to change your life for most people. So probably something like an online savings account would be a good place to start. Money markets are okay, but money markets do have fees, right? Money markets do have management fees you have to be considerate of. So that might eat into that return you're expecting. But if all you have is money inside of an account like a 401k or IRA, then money market might be what your best option is at that point. So that's probably how I'd be looking at it. If you're retiring for 2 years at 55, yeah. So we're talking here about 7 years or 6 years until you need this money. You can also consider breaking it up, right? You can look at something like an online savings account, and then you can also look at something like like a bond ladder, or something like that you can get different interest rates that might be a little bit higher than the savings account. Again, it's just challenging right now in this fixed income environment. And so the way I'm looking at it is don't worry about it, right, on the short-term money. Let's really focus on the long-term money and the money that we don't need for 10, 15, or 20 years or more. We can be a little bit more aggressive with that money to make it up, on the overall portfolio. But I really want to make sure that you have the money you need today, or at least for the next couple of years at a time, and that money's there for you. So that's kind of how I think about it, Scott. Hopefully that's helpful to you. Let's see here what other questions we have. So let's see here. Okay, so financial ideas are money. So what are you asking? I'm a little bit confused about this question. Financial ideas are money. So yeah, Renate, if you can clarify this question, I'd appreciate it because I'm not too sure what you're asking there. Let's see here. So Tamara's asking, where do you put safe money? Again, somewhere safe, right? Savings accounts are very safe. Things like, a short-term annuity, very safe again, but then you're locking money up. So you have to look at the cost benefit of that. But there's not really accounts that are paying, X number of dollars, 3, 4, 5, 6% that are 100% safe without any sort of conditions with them, at this point. So I'd really be looking at the overall portfolio, Tamara, and saying, let's keep some money safe, online savings account, somewhere like that high interest savings or checking account for the short term. Okay, Renate, I got it. Someone made a comment you replied to. Thank you. Thank you for clarifying that. Let's see. Okay. So this is like the classic question, right? How do we invest to get regular income? So Tanu, I'm hopefully pronouncing your name right. What we do and what we teach is looking at time segmented investing, right? So looking at your overall retirement portfolio and looking at your retirement income needs. So when we're helping clients out, we do what's called a retirement income plan. Okay, and a retirement income plan is we're gonna spend time mapping out, first of all, what can you safely spend in the early years, and making sure you have a game plan for all your basic expenses being covered, and then your wants being covered after that. So things like vacations or extra eating out, whatever it may be that's important to you. And once we have a really clear picture on what you're going to need, then we start breaking up your overall. Let me see if I can pull up a picture here. I think this will be helpful for you. Let's see. I have one that I was working on here. Let me pull up something that we can look at. I'll give you a picture. All right. Let me see if I can share this with you guys here, because I think this will be helpful to what you're asking. I have a little bit of trouble sharing here for some reason. It doesn't want to come up. Give me 1 second here. Okay, let me switch this to this other slide I'm looking at. Okay, so Tanu, let's talk about this. So here's an example, of what I'm talking about here. Oops, sorry about that. When you're looking over your overall, retirement portfolio, there's going to be, a time, right? So you're going to have your early retirement, and you're going to have your mid-retirement, and you're going to have your late retirement. So the way we look at it is most retirement timeframes are somewhere between 25 to 35 years. That's kind of the normal, right? If you're 65 and, if you're planning to live till 90 or so, again, it's just somewhere to start, that is 25 years. So what you could do is basically look at your overall portfolio in this sense, and then figure out what your expenses are going to be, what your income needs going to be, and then break that up into different segments, right? So in this case, it'd be like 5 years each. So you can have segment one that has, no market risk, and that's going to be something where you could probably generate about 1.5%, right? Then you can go to segment two, and this is where you can start to look at more fixed income instruments that can give you something, and this could be an annuity, could be, a bond ladder, could be some bond funds, somewhere hopefully between, 2 to 3 to 4%. And that's, you'd put a section of money there for what you would need for that time period from 5 years from now. And then in segment three, you can start to look at adding some growth assets, right? And, then you can add some growth assets in there, have some sort of a conservative portfolio, and ideally you can get a little bit higher return there. And then when you get to segment four, now we're talking about money that we're not needing for 15 or 20 years potentially at this point. Now you can start to go a little bit more aggressive with your money there, and again, ideally generate higher expected returns over time. And then in segment five, that's money you're not going to need for maybe 20 or even 25 years from now. Then you can go extra aggressive, right? So the way we look at it is segment one money, you're just going to get the best interest rates that you can, generate as much income as you can. But you want the rest of your money to be growing for you and generating higher rates than you can get on a guaranteed and no market risk perspective. And then each year, as you kind of spend the money that's in segment one, as you can see the arrows here, these arrows here, you are going to essentially take money and move it from segment three down to segment two, and from segment two down to segment one, right? And you're going to continue to refill these lower segments over time as the years go by. So, each segment is going to have different assets in them, and they're going to be more aggressive as you go up here, over time. So how you would generate income is start with what you can get. That's for sure. Again, right now it's basically a savings account. And then each year, you're going to want to look at your portfolio. And from that portfolio, look at your different segments and figure out which ones performed at the level you expected or better. And that's where you would draw some income, and you bring that down here to segment one and put it in that no risk bucket. So this is the way we look at plans and managing plans over time, that really help you generate the income that you need, while also, not giving up, that long-term growth that most people are going to want when it comes to their, their long-term portfolio. So, hopefully that is helpful to you and can help you see how we think about it, right? Let's see here, what else we got. All right. Okay, let's talk about this question here. Let me take this off. Okay, so Larry, would you suggest, if you're doing a bridge account, putting part of your money in the market and part of it in the savings account or money market if you plan to retire in the next 3 to 4 years? So this is going to come back to what I mentioned about risk tolerance, right? So Larry, what would happen if the part you put in the market went down 40 or 50%? Would you still have enough money to meet your goals and meet your income need, or not, right? If you can handle the risk, and if this particular risk did not completely blow up your retirement plan, then maybe you can put some in there, right? Maybe that is something you could do. You could do some sort of conservative portfolio potentially, but this is really going to come down to your risk and what would happen if you have, let's say, 4 years of money put aside, and that money, half of it's in the market, and then half went down 50%. So that would mean the whole amount you put in there, so the 4 years of money would now be really 3 years of money, right? How does that affect your long-term game plan? Would you have to draw more from your IRA or 401k, for example, to then refill that bucket? I'm more of a fan of taking the conservative approach for shorter term, because if you can retire and you have more than enough money, it just doesn't make sense to take the extra risk. But if you took this risk, Larry, and that portion that was in the market went down 50%, and you would still be fine on the long term. You could just draw a little bit more from your 401k or IRA or one of the higher segments, like I mentioned. You can draw from segment 3, 4, or 5 to then refill segment 1. Then maybe it's okay. But again, this is a very individualized question, so you definitely want to look at your overall retirement income plan. And then, the way we do it is get very specific year by year, time period by time period, and invest according to those time periods. So I would probably lean more towards not putting it in the market if you need it in 3 or 4 years, because that's just really short term. And the next couple of years are probably going to be a little more turbulent and not as clear as we expect them to be. This virus thing has just caused absolute, chaos and just hectic things that are just not normal, right? This is not something we've really experienced. And when we're looking at, some of the comments I'm seeing in the group here, different states are handling them differently, which means we're not going to have a consistent business perspective, because if, Larry, your state, everything's on lockdown and no one can, do business, well, the businesses that are in that state are going to have a lot of problems. If you're in other states where businesses are open and things are going great and there's no virus affecting people there, then those places are going to do better. So when you're looking at 3 to 4 years, Larry, it's really probably better to be on the conservative side of that. Again, depending less, like let's say you have $1 million more than you need in your retirement accounts to cover your expenses. Well, if that portion goes down 50%, it's not going to totally change your life, right? You could just pull a little bit more out of your account, refill that bucket, and then cover your 4 years. So, again, it's really individualized on that, but I would err more on the conservative side and be looking at more things that are like fixed interest versus trying to do some growth assets if you need the money in 2 or 3 years. That's probably a safer bet for you, okay? Okay, here's a good question here. I like this one because this one's interesting. So, thoughts on short-term and intermediate-term bond funds? Yeah, so Mark, this is a good question, because when the market took its dip back in February, I think it was February, 17th or 18th, there was such a rush to get money out of bond funds that some of the biggest bond funds that have just been very consistent over time got absolutely crushed. I mean, down 15 or 20% on some of these bond funds, some of these the high yield bond funds. And so intermediate term bond funds, again, generally you want to have some in your portfolio, right? Because generally shorter term bond funds pay less than intermediate, which pay less than long term. That's kind of the norm. Like the longer you are willing to leave your money in the fund, the higher interest generally you should get paid. And the shorter term you're going to leave the money in there, the more guaranteed it is, the less you're going to get paid. So, looking at intermediates right now, with interest rates being where they're at, it's really a tough question, right? So I'd want to know more about what you need this money for and when, because if you don't need this money for 15 years plus, then intermediate bond funds are probably fine. But if you need the money in the next 1 or 2 years, then you probably want to lean more on the short-term bond funds. So that's kind of how I think about it. Again, you want to definitely partner with your advisor, to make sure you get a plan that's for you. But that's just how I think about that question in general. So, all right, folks. So I think that's all the questions I have. I hope this was helpful for you. If you need to talk to somebody, if you like to talk to somebody, we do offer complimentary consultations, and you can schedule one on our calendar. We definitely have times available, and we do virtual appointments, right? We've been a virtual firm ever since we opened in 2016. And so we work with clients in about 37 states at this point. So regardless of where you're at in the country, I'm pretty sure we can help you out. And the nice thing is we don't have to worry about the whole Corona deal, social distancing and all that. We can just meet like we're meeting here and have a conversation about your retirement. And what I call these calls is a retirement strategy call. So what we'll do is spend about 45 minutes to an hour with you discussing your retirement, learning about what's currently on your mind, learning about where you're at, and then figuring out from you where you want to go. And then we'll talk about what sort of steps that you'll probably need to do to get there. What I found is most people really aren't thinking about the big picture, and they're missing a lot of little details. So usually these calls are very enlightening for people. And it can really help you get together a game plan of the things that you need to be doing to make sure you're ready for retirement. And if those are things that you could use our help with, and and it makes sense and it's a fit for both of us, we can talk about working together. But if not, that's okay too. These are complimentary calls. But if you'd like to schedule a call to discuss your retirement game plan, you can go to keepitsimplefinancial.com/talk. Once again, that's keepitsimplefinancial.com/talk. And from there, you'll find my calendar, and you'll be able to schedule an appointment that works for you. And I'll be taking a call with you personally and helping you break down your overall situation and give you some insights on what I see based on where you're at and where you want to go. So hopefully you enjoyed this today. Appreciate you guys. I look forward to speak with you if you schedule a call. Other than that, like I said, I'm going to be trying to do more more videos here with you, more workshops, just answering questions like this, because I think these are really, at least I hope it's helpful. So if you enjoyed this, and if you thought this question or these question answering is helpful, please leave me a comment and let me know, because if you don't find it helpful, and then I won't do them. But I really want to start digging into some of these questions that I think you're having, and do my little part here and my side of the world to help you maybe feel more comfortable or be better educated as you're getting ready for retirement. Because most of you are only looking at one situation, right? You're looking at your own situation. You're kind of like in your own world, and sometimes it can be very challenging to think outside the box, when it comes to your overall retirement scenario. I've personally looked at over 250 situations in the last couple of years. And so I've kind of seen these things over and over. And there's there's certain puzzle pieces you need to put together, right? Everybody has Social Security timing. Everybody wants to generate income. Everyone needs to make sure that they don't run out of money. Everybody needs to plan for long-term care in case they have expenses, estate planning, all these type of things that are going to come up. So when you have somebody that's seen this hundreds of times versus you looking at your situation once, I think it can really bring you a lot more information and clarity on how to make good decisions when it comes to the next step. So, I'd love to speak with you. If you want to schedule a call, keepitsimplefinancial.com/talk. And if you have questions you want to ask, just go ahead and drop them in the group or on the page here. And I'll pick from these questions and pull them up, and then I'll answer them with you in more depth. Okay, so have a great afternoon. Appreciate you guys. Thanks again for watching. I really appreciate you watching. And if you need anything at all, just feel free to reach out, okay? Have a great day. Bye-bye.